Hello everyone and welcome to Market Talks. I'm Ray Salmond, head of markets here at Cointelegraph. Here on the show we discuss the latest in what's shaping the markets with valuable insights from industry leaders, traders, and influencers. On this week's episode of Market Talks we have Jamie Coutts, a chartered market technician and crypto market analyst at Bloomberg Intelligence. Jamie's career in financial markets began in Australia with Credit Suisse as a stockbroker. He then moved abroad working in London and Singapore in equity sales and trading for BGC and Tudor Capital Management. In 2014, Jamie joined Bloomberg as a senior APAC buy-side equity market specialist, and in 2016 he became fully immersed in the crypto and digital asset space, helping to shape the product offering and sales strategy for Bloomberg before transitioning into a new role as an analyst at Bloomberg Intelligence, where he covers the emerging asset class. So, Jamie, how are you feeling about macro and crypto markets at the moment? And are there any prevailing trends that you are observing at the moment?
So at the moment we've got, my feelings are a little bit sanguine about the space, just because of what's happening on the macro side of things. There's a lot of development happening within crypto. That has been unrelenting throughout the bear market and throughout sort of 2023 as well, as we sort of came out of the sell-off, the liquidations, the capitulation of 2022. But the macro situation hasn't really given much room for markets to move higher or move any further higher than where they are now after the recovery rally. And that's really just a function of the fact that central banks are still maintaining a very tight policy stance. And that has really been, that's been longer than most people would have anticipated. I'm certainly in that camp. I thought by this point in the year, we would have at least seen a pausing. That doesn't seem to be the case, but I think we're more at we're closer to the end of the tightening cycle. It's just the resolve of the central banks to maintain tight liquidity conditions is surprised most people, and I think that's ultimately going to cause a lot of issues in the next sort of 6 to 9 months on the economic front. So really, for crypto, without liquidity, without an improvement in liquidity, and there's a lot of different ways that you can measure liquidity. It tends to be this term that gets thrown around, and you can look at it through multiple lenses, and I can go into that if you're interested. But liquidity really drives risk assets. It's very clear, and at the moment, the correlation being what it is, you can't expect risk assets, especially the riskiest assets, in that spectrum, to outperform.
I wonder, first of all, I'll say I think there's a lot of investor bias that are impacting people's view on the market, because I think beyond the Fed saying that inflation is transitory, which they've kind of walked back a little bit and seem to have admitted that that was a miscalculation or a misinterpretation, the Fed's been very clear about its monetary policy agenda and what their intentions are, right? Which is get inflation below 2%. They've been pretty clear about what their terminal rate is for these rate hikes. They've been pretty clear about what are their intentions on pausing and how markets need to cool down, how we need to see rising wages begin to sink, open job openings begin to kind of taper off, job openings with high wages where laborers have had a lot of, agency and autonomy in commanding a wage, a competitive wage. We've begun to see that taper off. I mean, the Fed's been very clear about the economy needs to cool off. We will do whatever it takes for that to happen. And of course, what shocked a lot of people is the hated rally of equities just going up, 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 and seeming to not buy into that logic. But then if we pedal back and consider the impact that the Magnificent Seven and tech companies have had on propelling equities higher, then that kind of makes sense. But I do think a bit of bias from investors is kind of clouding people's vision on where we're headed. So with that said, what's more important, global liquidity or US liquidity? So when I think of like M2 and monetary expansion for crypto, for risk assets, what do you think is the catalyst that kind of turns on risk sentiment on part of investors? Global liquidity increases or just increases in US liquidity?
Well, US liquidity has always driven global liquidity, so it really starts with the US, but more and more the Chinese impact on global liquidity is coming to the fore. So I think what's happened in China this year has caught a lot of people by surprise. It seems in the last couple of months that they are they're restarting their efforts to pump a little bit more liquidity into their system, which is obviously going through a massive upheaval. Problems that have existed for over a decade are starting to realize. And so I think the authorities there are desperate to try and stave off any sort of economic calamity. And we're starting to see some of the liquidity measures improve. So that's sort of counteracting what we're seeing as global tightening outside of China. But I think the US is really still the most important market in terms of liquidity.
Right. There's a meme in crypto that it's different this time, right? Like, regardless of whatever happens, whatever calamity or black swan falls at the feet of crypto investors, it's going to be different this next time, or it's going to be different this time. So that makes me think about QT versus QE. Bitcoin was born out of QE, right? Bitcoin was a result, just like equities markets did a 6x during quantitative easing and all the helicopter money that Bernanke and Bush dropped on us Americans. Bitcoin benefited from that. Equities benefited from that. Wages went up because of that. Housing, like the value of homes went up for that. And I wish I could go back in time and realize how much power you have in owning debt when there's 0% interest rates, because I would have gone out and bought like a Galanda wagon and a bigger house, and I would have leveraged low interest debt to go and buy tangible goods that have value, maybe even like a Ferrari F250 or a 355 Berlinette or something. I would have just gone ham. So I wish I could go back in time. But the question here is it different this time? We've got a halving coming up with Bitcoin. People say that is like the launch pad of the next bull market. We've got all these ETF listings that are just waiting for approval. There's so many things that are looking fantastic for Bitcoin right now, but the difference is the globe is tightening, right? Like liquidity is really tight across the board. So are investors drinking their own Kool-Aid and thinking that we're going to see six-figure Bitcoin and a crypto bull market rally just because the halving's coming up? Or do you think QT is going to alter the outcome this time?
Well, yeah, I've been writing about this, Ray, for most of the year. So we do have like some strong fundamentals in the space, but I think ultimately what drives risk assets is liquidity. And so the longer that we have this tightening cycle, and if we start to see more fractures with employment starting to tick up, or more stress in the banking sector, there'll be a little bit more pain that the space has to go through, inevitably. There are assets in the space which are relatively stronger than other ones, and Bitcoin is really the apex asset within the space. Once you start looking down that risk curve to the other alts, then they have a much weaker sort of basis in this environment. But I do think that we're sort of near the end, and we're already starting to see, fractures appearing. The BTFP program that the Fed initiated with the bailouts of several banks earlier this year. I mean, the banks in the United States are still tapping that facility. They're still sitting on unrealized losses in their treasury assets that they hold. That's only worsening. So there is still a lot of underlying stress in the US banking system. Deposits are starting to resume the downward trend that really started at the end of last year and was stemmed by the Fed's intervention. If you look at US deposits at large commercial banks and small commercial banks, they've started to roll over again. So I think, this is somewhat different to any other Bitcoin cycle that we've seen. But ultimately, people will need to just keep in mind that we are living in a fiat-based, credit-based or credit money system. And inevitably, there will need to be a return to some form of easing because essentially the system cannot handle long periods of deflation. So it is still Bitcoin and to some degree crypto assets that have a control on their inflation schedules that will do well when things start to resume.
I think something that amateur and retail investors also overlook, just because the narrative of fin Twitter, right? Or we got to find a new name for it because it's not Twitter anymore, so we can't call it like fintech Twitter. But a lot of people, their primary input financially and market macro and crypto wise is going to be Twitter, and they digest little tidbits of this and that from, anonymous poster and people like you who have credentials, and they use that to kind of build their own thesis on what's happening or what might happen in crypto and how they should invest, right? And I think something that they might overlook, because we've all been told that pivot, pivot, pivot is followed by easing, 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 and that even a rate pause is confirmation of an impending pivot. But I mean, in my view, and by all means, correct me if I'm wrong, rate hikes and a pause and a pivot and rate cuts, like what's going to induce cutting rates is that the economy has fallen into recession and we need to incentivize people to borrow and to spend, right? So I think people are kind of looking past the darkest that is yet to come and looking at this reversal in Bitcoin price as a result of QE coming back, right? But there could be 6 months to a year before that happens. And it could be 6 months to a year where Bitcoin price is trading 20 to 30% lower than where it is now. That could be a possibility. So in your view, do you think the return of QE can only be the byproduct of a recession? And in your view, do you think that that's a soft landing or a hard landing?
Well, I mean, so you're right, and I wrote a note back in sort of July, I think it was, where I said macro is going to make things get a lot harder before it gets better, and that was clear from the liquidity measures that I was looking at. And when typically you've seen the Fed have to cut, it is generally because, as you mentioned, the economy is sliding into recession. Corporate profits are cratering, and there's a massive rise in bankruptcies and in unemployment. Which, I mean, let's just pause for a second and let me sort of riff a little bit on how insane it is that we have the most important commodity to man, which is money, the price of money, being set in a room by a table of grey hairs and using mainly backward-looking indicators. I mean, they essentially flooded the system. It's not just the central bank, of course. It's the government that issues more and more debt year on year. But the central bank, facilitates that. It endorses that behavior. They flood the system with, excess money and debasing all of us at the same time. And their answer to this is to basically put people out of work. That's what they're saying. So, I mean, I think just, we have to stop and pause and think about the language that they use, because they try to cloak it in a lot of nomenclature, which is not easily understood by the general public. But that's essentially what they're doing, and there has to be a better way. That's the promise of crypto in its, sort of base, first principles fundamentals, was that, code is a better way to determine, and the free market is the best way to determine the price of goods and services, and the most important thing of all, the price of money. That aside, we've got potentially, 6 to 12 to maybe even 18 months of really bruising markets. That certainly wasn't in my crystal ball at the start of the year. But I don't think that the Fed would just immediately, slide back into QE straight away. Powell is really, he's got a thing with his legacy and his credibility, which, you know, in some ways I do respect, that he's actually managed to stop the freight train of just easy money that led us to where we are. But he himself was the cause of that, at least in the last 4 years of his tenure. He had an opportunity to, you know, cut this off earlier, and he chose not to. And now he is trying to, you know, resurrect some sort of credibility for the institution that he represents and for those that will be in his seat after he leaves. But I think that credibility has pretty much been torn to shreds, and there's not much that can be done about it. But we just might have to endure a much longer sort of period of poor asset prices and tighter liquidity, even if we are sliding into recession, even if the numbers are generating higher unemployment and higher bankruptcies. It just seems to be the stance that they're taking.
Heavy is the head that wears the crown, isn't it?
Yeah. I mean, it's interesting when you go back and look at the transcripts from early 2010s when Powell was on the board, and he was very much against he wouldn't say he was against, he cited concerns with the policy track that the Fed at that time, under Bernanke and then under Yellen, were pursuing with quantitative easing. But, you know, he got into the role, I think, in 2018. And as soon as he saw the first port of, there's a crisis, which happened with the repo market, you know, he did what his predecessors had done. And I think that just, that really does paint a very clear picture that there's almost no way out for the US now, and especially with government debt where it is, with interest payments above $1 trillion. QE will have to return, but I suspect they'll put lipstick on the pig and call it something else, or do something slightly different, but they're going to have to monetize the interest payments of the government, because the interest payments now have grown so large and so unsustainable that the only natural buyer of US treasuries going forward would not be the Chinese, would not be the Japanese, would not be private investors. It's likely to be the central bank. So, you know, I'm not a glary-eyed optimist about crypto prices in the short term, but longer term, you know, assets that are stores of value that do have debasement protection properties, and really we're only talking about a few within crypto. You know, there is Bitcoin, undisputed. Ethereum has sound money properties. It isn't really striving to be the reserve asset of the world like Bitcoin or the Bitcoin advocates would say that it is. And really, there isn't much else in the space because they're highly inflationary, and unless they change their tokenomics, probably won't offer those sort of properties in any case. So, but those assets, I think, you know, will obviously return to their prior glory and being the best debasement hedges of all risk assets.
Yeah, I pretty much agree with you. One of your colleagues, Mike McGlone, seems to believe that Bitcoin is going to drop to $10,000 per coin. How do you feel about that?
Look, anything's possible. I think there's a lot of support that built up in the 15, 16, 17,000 level last year because of the degree of the liquidations that took place. So let's just sort of analyze what a bear market bottom usually incorporates. So the things that I draw from studying the previous cycles of Bitcoin and just general markets as a technician and being in the markets for a while is that you look for certain characteristics. And the great thing about crypto, Bitcoin we're talking about here, is the level of transparency that you get that you don't necessarily get in, say, equity markets. And what we could see on chain was the level of realized losses from people selling into those lows were second or third highest in terms of the percentage of market cap in Bitcoin's history. And whenever you see realized losses spike to those levels, you've generally seen, well, not generally, you have 100% seen a bottom either within the next couple of days or in the next couple of weeks. And that's what we saw. So we had all those liquidations. We had, you know, the speculative fervor of 2020 and 2021 get wiped out. Leverage get wiped out. Bad actors get wiped out. Now you could say this time we've still got Binance to deal with. And if Binance goes, it is definitely feasible that we take out those lows. But a lot of the excess leverage has been cleared. And I don't think, that you've got these sort of imbalances in the system that you did previously with speculative positioning. But anything is possible. So if the Fed really wants to create a deep recession, then crypto prices, along with equity prices, will go much lower from here. I don't really have a number, but I think we'll probably hold at those lows if things get a lot worse. But you can't rule anything out.
Yeah, I agree with you. I do have Binance on my short-term radar as a potential huge black swan, but beyond that, the data shows that sellers of last resort have been cleared out of the market for a long time. It's been so long since I've even thought about it. Like, it would have been 6+ months ago that sellers of last resort were cleared out of the market. So the danger would be if Binance or Coinbase or any of the top 10, Bitcoin holders become a seller of last resort themselves. Then that could become problematic. Like if Grayscale or Binance, who has like 500K Bitcoin or someone like that, had no choice but to liquidate their assets. That would be a problem, but I would like to imagine, I don't know, I'm not a financial law guy, but I'd like to imagine that supply they hold would be absorbed by all these ETF applicants who would, in backroom deals, just basically take custody of those assets, I would think, but that's something else. So going back to Bitcoin before we explore a few other things. So macro is not very good right now. And of course, the correlation between macro and risk assets would suggest that Bitcoin price remains in flux with a higher percentage of downside in the short term. But something that we saw during the regional banking crisis and when SVG and Citadel blew up was an ideological shift. And one thing I've been telling all my friends and like fellow investors and economists is that I don't think that liquidity, of course, liquidity is important, right? And inflows into crypto are necessary. And in order to see an uptick in inflows into crypto, we need to either see one of these spot ETFs approved, or we need to see some sort of clear US-led regulatory framework, which makes it easier for companies, corporations, and builders to employ people in this space and to build in this space and to offer goods and services or products in this space. So those are things we need to see in order to catalyze more inflows back into crypto that are sticky and rotate and circulate within this space, right? But beyond that, I think the true catalyst of what will make Bitcoin an attractive asset is a change in sentiment, an ideological shift which causes retail investors, but more so money managers, to move further up the risk curve. What's your thought on that? Do you have any ideas on, of course, earnings are going to go down. Equities are going to take a hit. When the Fed begins to cut rates, then these 5% rates that we're seeing on treasuries and in money market accounts are going to start to go down, right? And already smart people like Jury and Timmer at Fidelity are saying that, the Magnificent Seven and earnings from big companies in the Dow and S&P 500 are going to begin to flatten, or they're going to pull back a little bit. And these are things I think that incentivize people that are investing to go search for yield, right? So I do see that as something that is going to happen. But what other ideological shifts do you see on part of institutional investors and perhaps retail investors that will encourage them to go further out on the risk curve and also look at Bitcoin as this is the sound money, hard money, deflationary asset that I'm willing to invest in for portfolio protection, for perhaps getting that outsized gain. If I allocate 3% of my portfolio to Bitcoin, that's giving me one more percentage point at the end of the year. And maybe I lost 1.5 percentage points based off of poor earnings in 2024. We also know that the dollar is losing its purchasing power. So some people argue that having Bitcoin in your portfolio, if you're a dollar cost averager or a multi-year investor, allows you to kind of escape the reduced purchasing power of the dollar. There's all these things, right, that I believe are ideological and kind of qualitative. So what's your take on what ideological catalyst are going to push people into investing in Bitcoin?
Yeah, it's a big question. So, look, I think, as we mentioned, things will probably get worse before they get better. And for a lot of investors, what they're going to, in order for them to understand Bitcoin's worth, they're going to probably have to see it survive another bear market, right? Or another economic collapse. That's what brings people over the line. So every single bear market, and I started looking at Bitcoin 2013, and I'm just trying to recall, it was the 14-15 bear market where I was watching the chart and I saw it had declined by 85% as it does. And I started to see it bottom and then start to rise. And I thought that's interesting because, very few assets recover from an 85% drawdown like this. And of course, it's had two since then. And every time you see the bear market start to recover, that proves its robustness in terms of its durability. And that brings more people in because the people that are already believers in Bitcoin, they're accumulating coins. You can see it on chain. If you look at the cohorts of addresses with anything between sort of, 0.1 to 10, which is, a sizable amount, but even in the smaller cohorts, 0.1 to 1 Bitcoin, the number of addresses are up and to the right, all-time highs. The number of addresses holding sort of 1 to 10, up and to the right, all-time highs. The large accounts, that hold maybe 10,000 coins, these are usually the exchanges and some of the large institutions. They're essentially flat. And FTX, tore a big hole in that cohort. So what we're seeing on chain is that, the hodler, the Bitcoin believer, has been using this entire period of the bear market to bring and absorb more coins. So for that cohort, nothing's really going to shake their resolve. For the new investors, it's a bigger question. For the institutions, they need the vehicles, they need the regulatory certainty to invest. And as soon as there's an ETF, the vehicle will be presented to them. But will they bite at the opportunity is the question. I would expect some to start accumulating despite the negative outlook. If it gets approved in sort of October, November, our guys, our ETF strategists who have been bang on with the progress of the ETF situation have got the percentage chance for, or the probability for an ETF to be approved in 2023 at around, well, now I'm not sure of the number. It's definitely above 80. It might be 80 to 85%. Okay, so the question is, will that be enough to bring in a lot of people when the liquidity outlook, or when liquidity is as tight as it is, and where there's definitely fractures appearing in the economy? I still don't think it'll be enough, right? I think it's hopium to start to believe that just because the ETF is approved, that suddenly, an overwhelming amount of capital moves into the space and props up Bitcoin. I think there will obviously be buyers, but there just won't be enough to stave off a bear market sort of reaction if everything's going down at the same time. Unfortunately, that's just the way I think it'll pan out. The vehicle will be there for when inevitably things turn. So for retail, I think they'll sit it out as well, and they'll get in late after the market rallies, after the bottom of the next time, because they generally are. But the ones who have done the work on Bitcoin and have sort of got that long-term view past the next 18 months, at least on chain, the evidence is very clear. They're unrelenting in terms of their acquisition of coins. And because Bitcoin's price is really set at the margin, it's set by the derivatives market, which is where the institutions play. That's not having a huge impact on the price, but it is a strong fundamental signal for Bitcoin. And eventually that will matter.
Whew. Oh, man. So with an ETF being approved at some point, do you think that cash and carry strategies will lead to Bitcoin price being as constrained as ETH has been? And then that kind of removes one of the buying impetus for a lot of retail investors, which is buy now and price go way up and sell, right?
Bitcoin's volatility is trending lower. I think that will be the case as more institutions move in. So there is a there is some concern that it is dampening the volatility. Now, I've always seen volatility in Bitcoin as a massive positive. Volatility can be managed through your position size. So, and most fund managers recognize this as well. So, Bitcoin being a hyper volatile asset was never a problem if its returns compensated you for that volatility. And I think with an asset, so you've got that at play, and that's really a reflection not necessarily just of the institutionalization that's happening in the asset class, but also because as adoption increases, it's on a sloping scale where it starts to diminish over time in terms of the percentage change, the rate of change of that adoption. So that has also been slowing. You can see that in on-chain data. So we haven't really talked about much what I do at Bloomberg Intelligence. So really why I came into this space is probably a good segue. But the reason why I came into this space was because there was, I felt that there was a real need to try to build a fundamental model, evaluation approach for crypto assets. So I really dug into the on-chain data and built out Bitcoin and Ethereum, and I'm working on other L1 models as we speak. And I write about this frequently, and it's up on Twitter, of course. But you can see in the on-chain data with active entities, a Glassnode metric on Bitcoin, that number's around 300,000 active entities. And active entities is a slightly better metric than active addresses because what Glassnode do is they use clustering and machine learning to sort of track the addresses that are associated with one another and sort of define them as an entity. So you sort of you normalize or remove some of the noise that moves of coins moving between individual addresses associated to the one entity. But that particular metric, active entities, is essentially flat. It's been flat for 5 years, let's say. It has gone as high as sort of 500,000, I think, in the 2021 bull market, but it's been around 300,000 average for the last 5 years. So in terms of just that one metric, which has a high correlation to the Bitcoin price, it's been pretty flat. So you need to see, really do need to see, some of these metrics start to break out of these ranges and go higher for price to also go higher.
Right. When you look at on-chain data, like specifically Glassnode data, are you just looking at these metrics in isolation, like the coin days destroyed, UTXOs, MVRV, Z-score, so on and so forth? Or are you building models where you're combining a number of those metrics to then build your own model, which gives you insights into Bitcoin price?
Yeah, so I mean, they are multivariable models. So we've done work around what metrics actually matter in terms of the price, which ones have the strongest correlation or have the best explanatory power for these assets. And then we're combining them together into some sort of fair value model to look at where the price is relative to that.
Is
and
fair
really
value realized price?
Realized price is a great valuation metric for Bitcoin, but I think it can be improved upon. But the logic's the same in the way that you look at price versus like the market cap versus the realized cap, and you can easily see when divergences are at their extremes that you tend to see tops and bottoms. All we're really trying to do is combine more metrics than just the realized value or realized price into the model and look for those extremes to try and improve the timing. But it is also a great way to check not necessarily where market sentiment is, because when price deviates a long way from realized price, you typically got this huge incentive to sell, and vice versa when it's the opposite way. But really what you want to do is use these on-chain metrics to look at what's the underlying health, like just a check-in on the network, like are things growing? Are they growing as fast as they have previously? Or are things slowing down or even declining? And that gives you just a temperature gauge of how the network is performing, its function as either a store of value monetary network in the case of Bitcoin, or its utility function as a center of commerce, which is really what Ethereum is trying to build on the internet in a permissionless peer-to-peer fashion, Web3 and all that stuff. And so Ethereum's a lot more complex, but essentially what you want to do is just build up a snapshot of like how healthy are these systems, and then obviously draw some sort of metric which will give you an understanding of where price is relative to that health. So whether you can say that it's undervalued or overvalued.
Right. I totally agree. I noticed that you're a CMT, so technical analysis is within your purview. Tell me 3 technical analysis oscillators or indicators or metrics that an everyday investor can use, or that you use every day when analyzing Bitcoin or Ethereum.
Well, I don't use indicators as much as I used to be honest. Price in and of itself is generally enough to go on. And so I do use oscillators on longer term charts. So that's maybe one thing I can sort of impart or share. So because I'm not really, I'm not trading it obviously, and I'm writing research for institutional clients, and they tend to be sort of more of they have a longer term view. I do a lot of work on the weekly chart, which is an eternity in Bitcoin because of the volatility, but it does actually allow you to zoom out. And the one sort of long-term chart that I've used for quite a while is the 200-week moving average, which does a good job of just tracing out the adoption curve in Bitcoin. And you can see within the 200-week moving average that the adoption curve is slowing. It's the rate of change of going up and to the right has diminished over time. But underneath that, the oscillators that I've used are an 11-week RSI and a Z-score of the difference between the price and that 200-week moving average. And I've got some back-tested signals on that, and just whenever you see the RSI and the Z-score go from deep negative and start to recover up, generally you've got the bottom in the rear view. And that's what gave me the signals, along with my liquidity signals in Q4 of last year. And I continue to use it. Now, actually, Bitcoin's just rolled back over and starting to sort of trigger some of those indicators again in some of the downside. So this is a very different cycle to the previous ones, as you mentioned. This is obviously a tightening cycle that we've never seen before, and Bitcoin is reacting accordingly to that. So it's not Bitcoin's failing; it is a symptom of the monetary environment that we are going through right now. So maybe just to sort of finish that on a technical question, oscillators are great, but they have to be used the right way. And when I was in the markets, a lot of people use technical analysis, but they said that they despise technical analysis as a discipline, but they'd put oscillators on their screen and they'd profess to know what the thing was doing based on an RSI, but not really understanding it. So a lot of these oscillators are momentum indicators, but people treat them as mean reversion indicators. So if a stock or a asset is breaking out to the upside and you get a very high reading on the RSI, I think the common mistake is to think that it's overbought, when actually that is a clear sign of strength and a signal that it's breaking out with strength and that it should be bought. So it can be used as a trend following sort of indicator, if that makes sense.
Thank you for saying it. I think where people make that mistake is they're looking at a 4-hour chart or 1-hour chart, a daily chart, and basing their entire methodology off that. So in their view, overbought and oversold do factor into that. Like they're attaching sentiment and volume to that actual to what the indicator's saying, whether it's overbought or oversold. And when you use these indicators on a higher time frame, such as a weekly or a monthly, it's more like, yes, momentum, trend changing, sentiment shifting, but not necessarily a mean reversion. So I agree with you. So as an editor, I'm always looking at stuff that people write, and they're like, this asset rallied by 15 or 30% or 40%. Therefore, the logical conclusion is that it must go down. And I'm like, no, that is not. You just can't assume that something that's up 40% must go down. The fact that it's up 40%, that's what should be piquing your interest. Go and figure out, like, why is this asset showing such strength? Where are the fundamentals for that strength? How sustainable are those fundamentals for that strength? You know, that's you got to go down the rabbit hole and find more evidence when such a shocking outcome occurs. So thank you for saying that. Do you think that artificial intelligence and on-chain data will kill technical analysis? Will it render it kind of an obsolete practice?
Good question. I haven't really thought about it, to be honest. I mean, I've been thinking about AI in a lot of different ways in terms of how it might interplay and interact or cooperate with crypto ecosystems. But I think a lot of the edge in the market is going to erode with AI. Over the years, building trading systems myself, and then seeing the really sophisticated shops with PhDs and statisticians building trading systems. I mean, all of that is really, it's formulaic. And eventually, if AI proliferates the way it's destined, I think a lot of the arbitrage, a lot of the opportunities that humans had in markets might be eroded away. But I haven't really given it much thought. I just generally think that that's likely to be the case. However, at the end of the day, you're still looking at humans being involved in markets, and humans being involved in markets means psychology still plays a role, and therefore we still will see boom busts as well as trends, right? So there will be opportunities to structurally position yourself in assets which will do well, that may require sort of less active trading and more sort of an asset allocation type strategy.
Yeah. Yeah, maybe markets will become more efficient, and the whole, I think the 60-40 portfolio is going out the window, but perhaps more efficient markets will make automated investment and passive investment and just easy allocation, one-click allocation for retail investors easier, because the trend over the last 10 years has been the extinction of pensions offered by companies that you might work at for most of your life. And then they're also offboarding the 401k and the pension management and the, all that sort of your retirement future responsibility onto the worker also. And we've seen Schwab, Fidelity, T. Rowe Price, BlackRock, all of them step into that and attempt to build these dashboards and technical analysis suites where you can be your own investor and ignore the metric that like 95% of self-traders end up with losses at the end of the year. So hopefully AI will help us as the common man has to endeavor into, managing his own portfolio on his own. Maybe that'll help us have more success there. Let's pivot to stablecoins, and then I think it'll be a good time to wrap it up. So you have a lot to say about stablecoins on your Twitter. You recently tweeted a thought about stablecoins having better PMF or product to market fit than crypto assets themselves. You suggested that we will continue to see mass adoption regardless of whether or not there is a crypto regulatory framework. So tell me why you think stablecoins could actually strengthen the US dollar's global dominance. I found that really interesting.
Well, because in regions outside of like strong Western liberal democracies, people there usually don't have access to, number one, a universally accepted medium of exchange, access to normal financial rails and services, nor do they have access to any kind of money that has store of value properties. And so the US dollar, for all of its faults, is still unequivocally the best alternative they have in a fiat in a fiat wrapper, right? So I think that with $6 trillion in stablecoin transfers in 2022, we're seeing global adoption of the US dollar on crypto rails in far-flung places around the world. And there's some analysis that I've done that confirms this, other than just looking at the headlines that you're reading about. And recently Circle, I believe, published data which from one of their surveys, which suggested that $500 billion had been transferred in Latin America with stablecoins. And when you look at the activity on Tron with Tether, you saw Ethereum. I was just trying to remember which chain I did this analysis, but I believe it was Ethereum. But clearly the level of Tether activity spikes into the crossover between Asia, Africa, and Europe and Middle East. And so, I mean, we know that Tether's being used for cross-border settlements in a lot of emerging markets, and it's potentially being used internally as a currency in a lot of these places, or a medium of exchange in a lot of these countries as well. So you've got it naturally being adopted. Meanwhile, you've got the Chinese digital yuan, which was obviously their domestic CBDC, being trialed and piloted in cross-border payments with some of their trade partners, specifically sort of like the One Belt, One Road trade partners and initiative. And now that's starting to gain traction. So you've got, the US dollar the US system has a private sector response to a problem that they know and understand, but have yet to develop their own solution for. And so I would love US regulators, and it's definitely the case with the stablecoin bill that's now before Congress and is being deliberated upon, that some of the legislatures are realizing that stablecoins do present the solution to the problem that they face, with a growing amount of, multi-polar sort of polarization or de-dollarization, which is taking place indisputably. It's not that the dollar is going away. It's not that the dollar still won't be the most dominant fiat. But clearly, we're seeing trends to bilateral trade agreements in domestic currencies, a much stronger BRICS presence. So the US has to respond. And if they don't allow stablecoins to proliferate, they may be too late with any version of some sort of central bank digital currency or state-sponsored version. So I think it's really up to them. They've got they could basically steal defeat from the jaws of victory if they fail to do something on stablecoins. But clearly the market's spoken. There's $6 trillion of stablecoin transfers in 2022. And this year, the level of stablecoin adoption and usage has not declined as much as other crypto assets like Bitcoin and Ethereum. So whilst the stablecoins are being used for, in great part for crypto pair trading on decentralized exchanges, the fact that they have not seen the level of sort of drop off in usage throughout the bear market suggests that it is being used for non-crypto, non-speculative purposes.
Interesting. It would be good if legislators played offense instead of defense, wouldn't it?
Yeah, I mean, the US is always, well, not always. The US used to be at the forefront. They were very proactive in the past. Now they're very reactive, which is, I think, a symptom of how fractured things have become in the US with the institutions. But they eventually get there. And they're sort of big enough to be a little bit slow. At least that's my optimistic view of what will eventually happen. Probably in 2024, we get a stablecoin bill passed, first and foremost, and then they address the crypto market regulations as well. Our Bloomberg Intelligence analysts have got a stablecoin bill probability of about 60% this year, and most likely done next year. And then a crypto regulation bill passed, if not next year, the year after.
Yeah, I agree with that, even though my basis is primarily just in the fact that we might have a change of president, and the Republican Party's pro-business and pro-money and beginning to emerge as being pro-crypto. I don't know if that's just because of the money that's there. You know, there's money to be made. So if we can legislate to chase after it and create jobs, why not? Or if it's that a growing number of our potential constituency is pro crypto and we can secure the vote by, you know, saying that this is part of our platform. So it's overdue, and we definitely need to see it happen. So the inverse of the stablecoin question, because just the other day I was chatting with some economists about stablecoins, and one suggested that stablecoins and their dominance in the market is a sign that Bitcoin, Ethereum, and altcoins had failed to achieve the mass adoption stage. I disagreed for a variety of reasons, but I'm curious what your thoughts on this might be.
Yeah, well, I don't think it's really fair to compare, you know, all of crypto to stablecoins, because it's really only a handful of cryptocurrencies that could even be considered as a money, you know. So a lot of these other digital assets and cryptocurrencies are centralized, they're non-transparent, they are highly inflationary, so they don't have the properties of money. Bitcoin obviously does, at least that's my central thesis. So when you're comparing stablecoins to the likes of Bitcoin, then, you know, there's a case to be made that stablecoins or that Bitcoin hasn't gained enough adoption that has sort of overtaken the need for a stablecoin to exist or a stablecoin to proliferate. But I think that both of these systems are going to operate in conjunction. And let's realize that if it wasn't for Bitcoin, and if it wasn't for Ethereum, and if it wasn't for crypto, stablecoins wouldn't exist. So stablecoins is just an expression of a need in the market to have fiat, which is still the best money there is, right? Like in terms of, the US dollar, which is the best fiat there is. And that's not necessarily, that's not me saying that fiat is a great form of money, but it does have product market fit, clearly. And the market is responding by wanting dollars, but they're wanting it on crypto rails because it does a better job of performance, of performing as money, as performing as a financial medium on a permissionless network that's peer-to-peer, faster, lower cost and whatnot. So you can't really divorce the two from one another. Stablecoins have got product market fit, but they only exist because crypto came along. And Bitcoin and Ethereum are slightly different value propositions. For day-to-day transfers and day-to-day usage in emerging markets, they're naturally going to lean into a stablecoin, a US dollar, because there's less education that's involved. But because they're using it on a crypto rail, they're suddenly going to get a slow education on other cryptocurrencies. And hopefully they can discern between the rubbish that's out there and what's actually real and has value, such as Bitcoin and even Ethereum, in my opinion. Yeah.
Yeah, I agree with you 100%. And I think a valuable takeaway from that is that crypto investors become more financially literate, whether they want to or not. It's just kind of it's a consequence of interacting with the blockchain and learning a little bit more about economics, because you have to. I mean, just the language of the crypto exchange and the things that impact Bitcoin or Ethereum or sometimes stable coins, and, you know, people's interest in price and what makes price go up, and realizing that macro equities, monetary policy, so on and so forth, these are all things that exert influence on their Bitcoin portfolio. And as a result of that, they just become like intrinsically interested in markets and in equities and then in Jackson Hole, and, you know, you just make yourself more literate. So that's one of the things that I do love about crypto, is that it's empowering once you get past the speculation.
Yeah. Now, what's the saying in Bitcoin? Like the Bitcoin maxis will say, you can't change Bitcoin, but Bitcoin changes you. It forces you to re-examine just about every aspect of your life. And I think that's a very positive outcome for everyone, whether it's health, psychology, money, family. It reshapes the way you think about things. And I think that's generally a very positive positive thing.
I agree. It's very infectious. Well, that pretty much wraps it up. Jamie, I really appreciate you coming on and sharing your brilliant mind with us and all of your insights. I can tell this is why you work at Bloomberg, doing what you do as a crypto market analyst there at Bloomberg Intelligence. If people want to keep up with your insights and thoughts, where's the best place for them to find you?
Yeah, thanks, Ray. Thanks for having me on. It was a real pleasure. So people can find me on, if you're a financial institution and you have a Bloomberg terminal, my research is there, but I try to democratize it and publish it wherever there's socials and wherever people want to view it. So you can find me on Twitter at Jamie1Coutts, Coutts. And I also just publish and send out research on an email distribution. So you can always hit me up on Twitter and give me your email address, and I'll just put you on that distribution.
All right. Thank you for coming on today. So, audience, you've been listening to Market Talks. I'm Ray Salmond. I'm here every Thursday. So, thanks for watching, and make sure you like, subscribe, and follow us on Cointelegraph.